Specific time. Did you all hear? This is the smart money. I didn't know they were going to use that modifier. So the standard is high.
A lot of pressure
is on. As the voice of God said, I'm John Bowman. I'm with the Chi Association. For those of you that don't know it, we're the professional body for the alternatives industry, and our mission is to build the most energized group of investment professionals around the world. So again, I'm thrilled to be here. Thanks again to Milken for letting. Actually, this is a double header for me, so apologies for those of you that were in private credit. You have to deal with me for another hour. But I'm delighted to be here to focus on the middle market private equity business. On Kaya's numbers, alternatives, meaning tradable strategies in all forms and flavors of private capital, are about $25 trillion now. And private equity, in all its forms and flavors, are 12 or so of that, so about half. Now, what we're talking about today, growth or middle market, typically as it's called, is still a small piece of that. But dry powder on some numbers, it's about half of where the fundraising is coming from. So as Molly and I were talking in the green room, this is where the cool kids are. Apparently, the trend is hot. And I think what a lot, maybe the opening statement I want to make, the premise that I think is going to define a lot of the course of our discussion over the next 54 minutes now, is about the evolution from kind of the financial wizardry of levered finance that came out of the 80s and 90s to this idea of business transformation, which I think is the purest form of the more optimal governance model that private equity offers. So excited to kind of unpack this with our panelists today. We are not going to introduce them. We're told, Milken, that you have all those bios. So we're going to jump right in. And Dean, I want to jump right into you, kind of building on the way I opened this entire panel, which is this idea of how we got here. Again, moving from levered finance to value creation. And you've been a pioneer in this kind of buy and build approach to private equity for a long time, if I may say so.
Thank you.
And so could you tell us a little bit about the catalysts and the triggers to how we move from that old form that was personalized in the movies and in Hollywood to today's form, which is very different?
Yeah. So, our strategy goes back to the early 80s. The firm was founded in 1980. And our strategy always starts with finding and partnering with great executives. And that's kind of step number one. And for us, we then, with those partners, we then go out in the industries that we specialize in. So our core verticals where we have a lot of expertise. And we look for a platform, a set of assets to buy and build and improve. So we're growth investors, but we're looking to transform companies. So an example of that is, we're bringing in a new team, we're upgrading the team, we're trying to upgrade the operations of the company to accelerate organic growth. Most to all of our companies do M&A, so they're trying to scale the business, make it more strategically relevant. And if all that works, at the end of the day, value creation for us is all about, building better businesses, transforming these businesses. And we like to say, the assets that we started with and the company we end up selling look very different in the end. And so our value add and our kind of value creation comes from, organic growth and largely multiple expansion by virtue of, building better businesses in the end. And it's been the same approach for GTCR, at least for 40 plus years now.
So that transformation of the playbook has also been partly motivated and in some sense demanded by the environment as well. So when perhaps David, you could help me with this. I mean, when we first started in the business, I'll say we because we've got some seasoning in both of us.
Thank you for including me. Right?
Yeah, exactly. Well, you've still got more hair than me, so well done. But in kind of the 80s and 90s, the business, the private equity business, again, that I would have grown up with, there was this burden, this urgency to move forward towards the IPO, to the halo of becoming public, kind of the big leagues. Now we know the story. 90% of companies are private. There's less reason. There's a lot more maturity in the private markets. It's largely satisfying everything that we needed the public markets to do. And I'm curious, as you've kind of grown up in the industry, how that's changed sourcing, competition, the way you think about your business, given how different the world is?
It's a big question. I entered the industry in '89. The Robert Bass Group, one of the big deals we did had 9% equity, very highly leveraged, very financial engineering oriented. In the early '90s, the advent of private equity sponsor groups and investment banks, major investment banks, which are now some of the biggest groups within the investment banks, if not, started creating efficiencies. And so I think that Golder Toma's strategy of buy and build, really adding value, was early and one that we've tried to follow ourselves. And the markets are just much more efficient than they were. They will continue to be so. There's always too much competition, so you need to have your differentiation and origination. And we try to bring that through our in-house operations group, which is about 45 professionals, about half our partners. And we find that most CEOs want the help. I was worried that they may not, that we'd be excluded. But when we show up with executives from the industry like Golder Toma does, you're talking a different language than if you're just an industry specialist. We are going through a very tough period in this industry. I think that private markets are growing, as you said. They're here to stay. I think they're a more efficient governance model, more aligned with shareholder value. But right now we have, I think, an extraordinary cycle that we're going through after the heyday of late up till COVID, and we're having the distributions of paid in capital ratios are very low. So this is an elongated cycle. We were joking earlier about, the M&A supply is coming any minute. we're waiting. It's been 3 years in a row. We expect quality companies to be sold. But it's a very challenging market that I think those with differentiated strategies will come out of it. But it's very hard for LPs right now.
And I definitely want to return to this differentiated strategies in a moment, because I think, as you've just alluded to, sometimes you can probably feel, unlike those early days, like you're operating in this commoditized business. There's been this huge number of entrants. It's the bar has really been raised as far as telling a unique story. And Andrew, maybe you could help me with that a little bit in thinking through the fact that there's been this pouring in of opportunities trying to exploit what has been a great opportunity. As I said earlier, probably a more optimal business model for pure private equity. But I have to imagine, looking around, that there needs maybe to be some washout, some rationalization of those that maybe jumped on the wave last versus those that have been surfing it for quite a while. Could you talk about that?
Sure. I think to the point of my colleagues on stage, the industry continues to evolve. I look back at my own background in the crisis of '08. I have a partner here, our co-chair, Marcelo Clare, a friend who really taught me how to operate a business. So I think operations has to be a part of that playbook for anyone going forward. We think the next evolution or frontier of the kind of haves and have-nots is not going to be the demarcation of capital, because everyone has capital. It's going to be who can innovate the model better. And I'll put the argument forward that if you're not deploying AI into your companies or don't have a path to do that on a very near-term basis, you're going to be left behind. So Marcelo's in the audience here. If you had invested $1 in Sprint when he took it over a decade ago, that would be worth about $12 today in the now T-Mobile stock. And a large part of that last move has been the deployment of AI at scale. You can see this publicly. This is all, again, on the public record. We have, in a smaller base, taken to the middle market, who tends to underinvest in technology relative to their large cap peers, AI-specific use cases that are driving value that we don't see our peers doing. We think many will do this, but it takes a lot more than sort of, let's say, signing up for a subscription with OpenAI. It's actually understanding how to use it. And I think that will be an interesting story in a few years from now on a similar panel of the haves and have-nots.
Well, you don't want to be in the have-nots panel.
No.
Stay away from that one. Molly, Andrew talked about innovation, and I want to press a bit more on AI in a little while. But more generally, I think if you're not familiar with Molly and what she's done at Oster, she in many ways has personified this idea of innovation. When you think about, from an LP perspective, finding the GPs that represent what you're trying to build at Oster's. What are some of those things you're looking for? What has really struck you in recent years?
So I put our goals into two categories: resilience for the portfolio and innovation. So middle market PE sits square in the resiliency bucket for us, first and foremost. As we're looking at the entire sliding scale of cap in private equity, sometimes it's very difficult for us to access lower middle market because it doesn't scale to our desired size. Although that is where you see the highest growth acceleration for most of these companies. On the larger end, we're having a hard time figuring out how these enormous companies exit. And what's the natural next step for some of these companies? IPOs, as we've all talked about, have been staggeringly hard. We, for the last 4 years, had a very active Department of Justice. We had a lot of things going on that were making that part of the market tough. And we think that if you look at what middle market can do, it can accept our capital, it can scale with us as we grow. It has healthier companies. If we're going into a recession, stagflation, inflation, these are companies that they have a little bit more balance sheet to work with typically. And so we think it's the Goldilocks spot of growth acceleration and exit opportunity at scale for us. So I start with that. On the innovation side, I think that I see more innovation in the company's development. I think that the deal teams, and then the ops teams that are going in and really making those companies, those portcos, as efficient and ready for whatever their next step of the journey is. I think I see a lot of creativity and innovation in that space. To Andrew's point, bringing in AI tools. I think there's a missed opportunity, though, and I know we're going to get to AI, and I'll just be a little provocative. You know, private equity firms are the pipe between the capital and the portco that needs the capital. And the reason for being in that is to source those exciting opportunities and connect it with capital for profit, obviously. I do think that AI needs to be thought of as what are the PE firms themselves going to do with AI. Is it an exciting opportunity or an existential threat? Because I could see 10 years from now that AI, it's the great knowledge equalizer. Right now when we're sourcing, we're looking for people who have the best talent, access to the capital they need, when they need it. They have a data advantage. They have a talent advantage. AI could actually take away a lot of the advantages that come in those decks that we review. And what we're really looking for is somebody who has a really strong point of view, not just on their portcos, but on themselves. Because we're going to be there for 10 to 15 years, and it's our capital at risk. So I think there's a lot of things that I would like to see innovated within the PE industry, not just at the portco level.
So park that. We'll definitely pressure these four gentlemen in a few minutes on just that subject. So I definitely want to reciprocate that as well. Scott, before we kind of move on to differentiation, as I promised, maybe one last stage setting question for kind of how we got here, which is maybe some definitional, foundational work about how this market segments itself, kind of sizing, philosophy, industry specialty, which I know is part of your story in particular. But could you just help give us a mental map of the world of middle market these days?
Yeah, sure. And it's sort of a tough question because everybody has their own mental map of what defines the middle market. I guess, Sherry, the way that I think about it is you have folks on the super small end, call it under 100 million of purchase price. So there's a certain segment of the private equity industry that's going after that. Then you've got a broader swath of middle market, which is, call it 100 million of enterprise value up to, call it 5 billion. And then you've got mega above 5 billion. So there's size, there's geography. Some folks focus on either North America or even sometimes a region of North America. You have country-specific funds in Europe and Asia. or you've got folks that look at things from an international basis. Then there's growth versus value. Folks like ourselves focus on lean into the value type situations where we're trying to buy things for 6 to 8 times cash flow. There's industry specialization. We're focused on industrials. There are other folks that focus only on software, and then there are other generalists that operate across a wide swath of industries. And then there's situational things like we tend to lean into corporate carve-outs. Other folks do sponsor-to-sponsor transactions really well. Some folks, like Andrew, focus on family and entrepreneur-focused businesses. So that's sort of how I think about the market, and everybody sort of has their own definition.
Yeah. So fantastic kind of overview of, I think, the where we've come from and where we are today. I want to shift, as I mentioned, just to give you kind of a progression of where I'd like to go, is spend some time at differentiation. We're going to camp out a little bit there because I think what you just described, Scott, is evident and manifested across this stage in many ways, and then move into a tackling, which I know a lot of you are very anxious to hear about, some of the current state of the markets and how you're adjusting. So, Dean, I want to come back to you because you made reference to great leaders and this idea of operational excellence, which is, you talk about business transformation, it has to start at the top. I think you actually have a trademark of leadership strategy. So maybe you could talk us through why that's such an important part of your model and how you go about delivering it.
Yeah, I mean, for us, it really all starts with the management team and the executives, and we just have believed for 40 years now that is, the biggest source of alpha in an investment. If we can find, A plus quality executives and build an A team, even if we apply that to B assets, we will end up with a good investment. And that's been a driving philosophy for us for a long time. A little bit unlike what we were talking about, our strategy does not involve using operating partners to drive efficiencies. So, the first bet we make is really on the team. And then what we're trying to do is, really accelerate organic growth, do M&A transformation like we talked about. But, focus areas for us in operations are, helping organic growth by, looking at pricing optimization, sales force efficiencies, using technology to help drive sales and margins. But that's really the focus is, where we can help our management team, what our plan is going in on how we're going to, execute some of those operational improvements. But, for us, the starting point also isn't really, kind of intensive operational turnarounds. We aspire to buy things at 6 to 8 times cash flows. That'd be great if we could start there. But so that's our approach. Is really, sometimes somebody once mentioned, it sounds more like a quality assurance rather than quality control. So we're trying to kind of build the quality into the company, into the team up front, and then use that as our lever to really, build better businesses, transform businesses like we were talking about.
Mm-hmm. And maybe, John, just to contrast, we start with an in-house group of operating partners. So we're looking for nice assets that we can buy at 6 to 8 times EBITDA, sort of irrespective of the management team. Because we have the confidence that if we don't have the right management team, we can make the changes that are necessary to find the right managers for that particular asset. So we're looking for something that's well-positioned, is available at that 6 to 8 times cash flow, and where the improvement is within our control. So those are the 3 criteria that we look for. And so it starts with having a view on the asset and knowing that we can, with the things that we have under our control, create that value, whether it's with the existing management team or not.
So can I just, before we move on, I understand everything you've said, but maybe, and David, you've talked about human capital too, so you can chime in as well. But the tension of this possibly, I'm sure that you face sometimes, is this idea of morale and awkwardness when, here comes the private equity firm bringing in their people, right? That has to, I assume you have to walk a fine line, even though you're introducing excellent people. How do you kind of thread that needle?
So we have a strategy that similar to Golder Toma's up, finding a management team, backing the right jockeys, if you will, but supplementing them with resources that middle market companies don't tend to have: HR, FP&A, IT, and then human capital management. We have 4 industrial psychologists at our firm that are used both up front in screening management teams, as well as the executives that we partner with, like in some ways Golder does, up front to go find assets. And often those executives will be the executive chairman. We make it very clear that we're here to bring resources and additional experiences and judgment to help you, senior management team, Mr. CEO. But at the end of the day, we're relying on you. And so we actually, obviously people are opting into us, but we don't have tension over the ultimate goal is creating shareholder value and an enduring business. And we'll get back to AI, which is a huge opportunity, but many of these companies have poor ERP systems or no ERP system. And so what you do with that as a starting point and then leverage AI is another. So there's all these examples of we buy top 3 competitors that are undermanaged and have opportunity. And we, about half the time, are backing the CEO that we buy it from, and the other half, maybe it's a founder who doesn't have a successor. We provide a solution. But the industrial psychologists have been really invaluable to us in both screening but also developing high-performance teams. So maybe it's too much San Francisco land of fruit and nuts, touchy-feely, but it's worked for us. And we've actually found it to be a competitive advantage and something that most management teams and their people that report to the senior want. Everybody enjoys growing.
Yeah.
It's what life is really about.
Dean and Scott, though, just to build on David's point, I have to imagine you've seen some leaders of portfolio companies that don't necessarily agree that they're undermanaged. When that happens, how do you walk that delicate line?
Please.
Yeah, sure. So in a corporate carve-out situation, it's very often the case that a corporate directive has come from the C-suite of a big business that identifies a non-core division. It's either dilutive to their growth strategy or it's dilutive to their margin strategy, and they want to get rid of it. And so if you think from the corporate directive perspective, it's not often the case that they'll put their A-plus managers in that entity that they want to sell off. That typically the A-plus managers go to the high-growth divisions that they want to keep. And so it is an exercise of figuring out, is this an asset that we want to own at a certain price? Are we solving a problem for the corporate parent? And in some cases, we have in-house operating partners who focus on human capital development and organizational performance. And they will go in and assess these managers and try to figure out, are they the ones that can move to that next level with the appropriate amount of guidance and capital and support from the folks that we have at One Rock, or do we need to make changes? And so, and in other cases, even when we're buying, we recently bought a 3rd generation family business, and they were looking for the operational help that we brought to the table. And because we have industry experts, to the comment that was made earlier, it is just a different level of discourse that we're able to have with those managers, and so it's actually really helppful to us. And we haven't found it to be the case where folks are like, they're definitely going to make changes. It's very situationally based, but the idea is that if we do need to make changes, we can make them.
Yeah, I'd just add to that because it's a really good question. I mean, by its very nature, a transaction or a sale creates uncertainty, creates anxiety for the people that work at the company. And, when we look to, and if you're changing the management team or changing leadership or the CEO, that adds even more kind of uncertainty and potentially risk. So, first of all, to your point, you're really thinking about, does your management team, in our case, or CEO really fit the culture of this company? Second, we really want our management teams to feel like they are owners and principals in these companies. Obviously, that's accomplished by issuing carry to the team, broadly speaking. So there's a lot of alignment with us. Our teams, broadly speaking, not only the senior teams, are co-investing in these companies. So they're writing checks as part of this transaction. That makes them feel like owners as well. But creating that alignment, creating that sense of ownership, creating that sense of, we have a mission here. We're going to try to, do X, Y, Z with this company over the next, 4 to 6 years. That helps, I think, bring people together with a common sense of mission. It's particularly applicable to when you're doing a corporate carve out, for example, and maybe that team, those employees didn't have any equity incentives in that division, didn't feel like owners. So for the first time now, it's a very different situation. But you really are trying to kind of control the risk associated with change and disruption, and doing it in every way you can, through incentives, through co-invest, through, all of these mechanisms.
Yeah, I think that alignment, anxiety, change management is maybe an underappreciated art in this business.
It's a huge issue, and I appreciate the spirit of your question, but we founded our ops group in 1999, and I was worried we'd lose half the deal flow. No, these people in the middle market, there may be a distinction between the middle market and large omega market. Mm-hmm. These executives want to talk to other specialists. So you bring somebody from the large market that's been there and done it. We find in diligence sessions, immediately they're talking to them, not us, deal people, and it helps build credibility versus all the people in blue jackets and white and blue shirts as to what we're building through the ultimate incentive, which is equity.
Yeah.
Ultimate alignment.
Andrew, I don't want to lose sight of you finishing out the GPs. You had a very unique way to articulate BrightStar's story, which was this idea of partnering with several stakeholders across 4 verticals. But could you talk us through your particular approach?
Sure. So look, we're focused on a big problem out there. The $105 trillion wealth transfer in the U.S. of one generation to another. Similar to some of my peers here, the background we have, though, is that many of us at the firm have both an investment and an operating background married into one. When we have a conversation with these families, founders, and entrepreneurs, it's really more about forming a relationship and not talking about a transaction. Transactions tend to follow when there's a need from the relationship. I'm going to fast forward, which is we actually have real life use cases of what we can do to help transform and increase the value of that business. And so taking that rollover component from maybe the current generation, the future generation, and help grow that meaningfully. So last year, we exited 3 investments through regular auctions, all of whom had components from the original stakeholders and multiplied that money significantly. We didn't really actually get a lot of multiple expansion, so this was not one of those stories of sort of buying something in a low interest rate environment, maybe enhancing the multiple. This was true hard work. The last exit we had of the year was actually taking a business that did something very simple, a fleet maintenance business called Demerit. It started with combustion engines. It started with large fleet operators in the U.S., and we worked with the founders to transform that business to start serving the EV customers. So maybe the driverless vehicle that may have taken you here today or something like that, or maybe the truck that shows up with a package to your door a few times a day. We managed in that business to more than quintuple the profit organically over a 3-year period by applying some very basic techniques. When we did go to market and we talked about starvation of DPI in this world, we were fortunate to have unlocked about $1 billion of equity value for our investors last year, which for the size of our fund was quite meaningful. And in this final sale, we actually took one step, which was, I call it buy an insurance policy. We actually recapitalized the business a few months ahead of our eventual sale of the business, giving our investors nearly 3 times their investment just through that recap, and then the eventual sale to a larger sponsor more than 5 times our investment. However, we did actually keep a stub, a meaningful stub, and some governance in that investment because we think the ultimate upside is quite a bit higher than the multiple that I just expressed. And so we think again, in the world we're in middle market private equity, the old sort of playbook of this pre-2021 deal of zero rates, free cost of money, multiple arbitrage has to be rethought.
So Molly, and I'm not just picking on these four gentlemen, but you get to be a managing partner at a firm like these four, and they all can tell great stories. And I'm wondering the advice you would give to the GP when you think about truly sifting through noise and real differentiated approaches to cash flow and diversification. What are you looking for specifically for your portfolio?
Returns.
No. I would say the number one thing I'm looking for is alignment with my goals. And not to dismiss all the wonderful marketing teams out there that put together beautiful books, but there's probably like 2 pages of that book I actually care about. I do care about how it's presented, that it shows a point of view. And you'd be surprised how many of those books do not show a point of view. They show me pretty pie charts and trend lines and all those lovely things that data people love. And maybe my junior team sits in that zone because they're trying to learn about your organizations. But I need to see a point of view. And I'm going to flip to the very back, which shows me the holdings. And I'm going to make sure that you sized your commitments and your deals to reflect your point of view. So the things you tell me are really important should be the highest checks you write. And then if you're doing a buy or build strategy, it should be where incremental capital goes for that buy or build strategy. And oftentimes you don't see that either. You don't see people putting their money where their mouth is, so to speak.
Just to confirm, the point of view is the strategy. Very clearly
Yes.
stated strategy, that is what you want.
Yes.
Then you want to see a track record that matches it.
Yes, and sizing and commitment to what you tell me is the most important value that you're seeking when you're doing your deals. Whether, it could be growth rate, it could be entry multiple, it could be all the different things you put together in the mix. But if I see that your biggest winners look like accidents, that's not a point of view. But alignment with my goals, I'm looking for honest interactions. I'm looking for fair fees. I'm not asking for fee cuts. I'm looking for things that make sense relative to your strategy and your peer group. I'm looking for transparency when we ask for things that are very important to us. We need to really think that we got all the data. And then one thing that's increasingly important to the larger allocators is access to co-investment. So that's one of the things we put on the table very quickly in the conversation. Now, if somebody's going to create 3x net for me, I might be a little less worried about getting my co-investment. But we're not just doing it to disintermediate fees. We're doing it because we're trying to take some of our portfolio inward. And that is allowing us to grow our talent, our team, and our understanding of your industries that you're deploying capital into. And that's very meaningful to us. So I think those types of things are front and center, on the first meeting with me.
So I'm going to move to the chaos of our current world in a moment, but I'm going to channel Molly one more time and come back to the last differentiation point I promised to return to, which is AI. So Andrew, maybe I'll start with you because you already mentioned it. And remember Molly's challenge. So yes, I want to hear what you're doing in your portfolio companies, but also tell us what you in your particular are doing at Brightstar as well.
Sure, I'll cover both. If I start with the portfolio company, again, our partner and co-chair, Marcelo, does chair Harvard's AI Institute. So we have a little bit of, I'd say, the sort of, insight into what the world's smartest people are doing and saying in AI. But I'm going to give you a very specific use case that happened earlier this year. We have an auto auction business. We don't own one asset. We're a marketplace. Most people will know Manheim. We're the second largest, called America's Auto Auction. One of our issues was trying to activate dormant buyers. So we serve the suppliers that are the world's largest banks, financing companies, OEMs, But the ability to have a great marketplace is again enhancing the buyer universe. We deployed AI against those dormant buyers in a marketing campaign, and we saw a 4% uplift in profits from that pilot sample, which was about 20% of our sites. That is economically worth $85 million of equity value in just this one investment alone. So we have a number of use cases that we are currently deploying, and we are scaling those over time and bringing that tool to companies that, again, in the middle market tend to be underinvested. We will do more and more of this. It's a part of our DNA. Going to what we're doing as a firm, we actually brought our LPAC in for a multi-hour session on what we're doing in AI. We'll do it again shortly to give them insight to use against other portfolios that they have. To Molly's point, I completely agree. The GP-LP dynamic is going to get rewritten over the next decade by AI. It's not only going to happen on the GP side, where again, we're using tools in our investment committee. We have a devil's advocate app that one of our chief strategy officer codes in his free time. So he wrote an app that says, as great as something is in your IC memo, we're going to find something that argues the opposite to be the devil's advocate. And we have multiple tools where we've brought AI into our everyday, and we require our team to use it. The more we use it, hopefully the better we get. I'll now take it to on the iPerceives and the asset allocator side, which is we offer co-investment a meaningful amount of times to our investors. We have some folks who programmatically just say yes every time for a certain allocation, and to Molly's point, maybe reflects where they have conviction. Then we have some folks whom I respect who re-underwrite the deal and effectively want to, and that will maybe be based more in a portfolio construction for them. I actually don't know what the data says at the end of the day, but I know this is something, again, where AI will have a perspective on which outcome ended up being better. And then there may actually be a cost savings eventually that comes with that. Because if you believe, again, that AI is sort of dispassionate and unemotional about it, it's going to do what's going to seek the best returns. So I think the industry is going to get rewritten. I do think, though, for that $105 trillion wealth transfer, it still relies upon someone saying, I want you to be my partner. So that might get displaced at some point in the future, but for the time being, there's still a partnership that is formed. But I think a lot of the value creation is going to shift to AI.
It's a bold statement that AI is going to completely rewrite the LP-GP relationship. David, I know you've done some work with AI as well. Do you agree with that?
Over time, I think that a lot of concepts for the middle market that are much more easily said than done. One of the reasons we have such a large ops group is to try to be as consistent as possible in implementing basic practices, and we don't achieve it all the time. You're only as good as the management team that you're backing. Of our 34 companies, every single one of them was lacking in basic ERP and business intelligence to manage their company. Now they don't have IT departments, okay? And now you want to put on top of them AI. You need to be very thoughtful, I think, in how you do it. We have a chief technology officer in our ops group, but we just recently landed a very accomplished individual from one of the biggest firms in the world who he is going to create a team. He's been there and done it, and he wants to do it in the middle market because he sees the ability to add value and high returns on capital and time, like to the factor of 10x. So we've been playing around, if you will, trying, but now we're really going to go to the next level with have 3 people within 2 months. And I do think it's going to. I think we're sat here 2 years ago, going to the AI panels, and just said, "Wow, the middle market is in the dark ages." The bigger firms have the resources, both within Blackstone, KKR, TPG, but their companies have the resources, given the size of their revenue bases and balance sheets. That's a different equation, which creates opportunity. So I agree with Andrew. It's going to be highly differentiating, high value added, and I think in a few years, LPs will be putting that on their checklist of what are you doing.
Molly, speaking from an LP perspective, I think you stood up a working group, did you call it, internally? What is the charter and who does that group serve?
So our entire organization so not just the investment side, but the administrative side of the pension plan, where we go through disability claims and we greenlight pensions for everyone and we process payroll and all the other things that happen. Our whole company began a commitment to AI in 2019. And so we have a working group inside our organization, but our CEO has now expanded that, and we have a global working group that gets on a call every single month. It's pensions, it's the U.S. Social Security system, it's pensions in most of the states. We have some of the European pension community now participating, because we really do feel like this. I saw something come out from, I think it was the World Economic Council, that said, what part of finance, investments, and insurance will be impacted by AI? What number of jobs? 98% of jobs are going to be impacted by AI in our industry, which moves money from one person to the next. And if you think about that, how are we thinking about it? Well, when agentic AI started to become a popular term in the last year, we're thinking that when you become a member and you're working for one of our unions or in one of our agencies that we support, you would get an AI agent on the day you start your first day on the job, and that AI agent would be your assistant through your trajectory of your career and into retirement. It would know when you have a child, when you have a divorce. It would know when you go on leave. It would know when you need to buy back service credits. It would know when you hit seminal moments for planning. And it would ping you and remind you and tell you what you need to do to get to the next level. We're trying to think about what that means for our investment team. How many people do we really need that supports this organization from an investment perspective when we can have an AI agent that walks with our thought leaders and does the work of today's analysts? Some of the other things that we're conceptualizing, we've created an internal chatbot. Our team can now just ping our Ask Molly, which they normally would do and walk into my office. They can just ping our internal AI chatbot and say, I'm working on this problem, bring all the policies, procedures, state laws, federal laws that I need to know to work this problem, and it all shows up at their fingertips and they don't have to fumble in the dark. So we're already incorporating it. Imagine a world where 10 years from now, right now we have a knowledge advantage in the finance business, largely. We have highly educated people who make a high wage because it costs them so much to get their college degrees, their internships, all the things that have put them in a position to be in jobs like these. AI is going to distribute knowledge. Knowledge is no longer going to be scarce, and it's not going to be behind some, gated community or velvet rope that you have to get someone and pay them high fees for that knowledge. So if it's not knowledge and it's not access, because maybe in the future AI knows enough about all of us that it matches the people who need money directly with the people who have money, and it becomes its own portal. And then the contracts are on smart contracts on the blockchain, and you don't need a host of lawyers. Like, there's a whole lot of things that we can envision into the future. And I think there's going to be a delineation between the people who thought about it and did something proactive about it and sat and waited for it to come to them. There's this great meme of, if you're stranded on a desert, if you're stranded on an island, are you the person that writes help on the sand and waits for someone to see it, or are you the person who's trying to figure out how to build a raft? And I think the people that are self-help people and are building a raft are going to be the ones that, at the end of the day, evolve their value add statement and stay relevant.
I think
LPs and GPs. The LPs are just as vulnerable.
Exactly. Kai is doing a lot of work on this, and we don't have time to unpack it, but I think the skill sets and the talent that are needed in the future of this industry are very different than, may I say, the very homogeneous, vertical way we've developed, recruited, talent historically, multidisciplinary lateral systems thinkers. It's a very different world, and I think those that stay in the old world are going to be outcompeted.
Well, the old world is judgment. That is what this industry is based on, is judgment.
Yeah.
And I think business models inside private equity firms are going to evolve, where the junior people, mid-level people are gathering, doing analysis and data. That's going to be like this. It's a question of can they think about how to use it, and then how can hopefully people throughout the organization, including senior guys, apply the judgment, and it's going to all move much more quickly.
It sure is. All right, as I
I gotta
promised,
say, Molly's approach and what's going on there is incredibly thoughtful, and sounds like you're really ahead of the game there.
I mean,
Very impressive.
One way I'm seeing it already in middle market, in the healthcare vertical especially, I'm seeing this. PE is not just investing in companies. They're actually looking at the white space inside the U.S. health system, and they're actually creating platform companies and then resourcing the talent. And the PE firms are the ones launching some new platform companies. They're not going and buying something and then evolving an existing platform. So I am seeing people really try to be stepping into their value statement a little differently than I had in the past.
so I want to make sure we get to chaos in these last 10 minutes.
If that wasn't chaos enough.
Yeah, no, that was just easy stuff. And by the way, audience, please submit your questions because I will work that in as we kind of approach the close here. But I want to go to Scott and Dean on this. And so, trade wars, deglobalization, tariffs. Oh my! How are you thinking about sourcing and the velocity of the business, and how is that changing risk premia or the way you think about origination and underwriting? How are you approaching this world that we live in today?
Yeah, it's a really good question. There's been a lot of chaos recently, and we focus only on the industrial segments of the economy, and we invest only in North America and European-based companies. And what we've seen over the past, call it 10 years now, starting with, shipping containers piling up on the ports here on the West Coast, to COVID, to now trade wars, is that there is a tendency for companies to shorten their supply chain whenever there is turmoil in supply chains. So that actually gives an advantage to those who are manufacturing or providing a service locally for the local economy. And so it's actually been a little bit of a tailwind for some of our companies who are manufacturing in the local environment for the local geography, provided, and big asterisk, provided that we're not getting raw materials from far-flung places. And so, in certain cases, we are coaching our management teams to be able to use that as a commercial advantage relative to their competition. So if we're competing, one of our chemical companies is competing with a Chinese competitor or Indian competitor, being that local supply to where our company's customers are manufacturing is actually an advantage. And sometimes we can get a premium for it. We can certainly pass through whatever we may be bearing in terms of tariffs to bring in raw materials. So it's a very interesting dynamic, a little bit counterintuitive, but it actually advantages folks that are manufacturing in the Western world.
Dean, I mean, we're not just dealing with a cycle, which we've all been through several. We're dealing with structural questions and regime change, and there's talk of the dollar, right? Things that we haven't seen on the bingo card in a long time, if ever. How are you kind of just wading your way through all of that?
Yeah. I'd say for us, firstly, as it relates to GTCR and our portfolio, we are very largely U.S. focused. Most of our assets are here. Most of our companies are kind of U.S. companies doing business with other U.S. companies, largely speaking. So at the first level of tariffs, FX changes, that kind of stuff, we're a little bit more immune on that front. So we're not putting out fires. But setting that aside, just broadly speaking, we've obviously entered a time of a lot of uncertainty and change. it's not only the policies that have changed, but it's hard to predict what the next policies are that are going to change and the next shoe to drop. For us, we've been through a lot of dislocations and disruptions. Obviously, COVID was a big one. Post-COVID, rates going up, wage inflation, wage turnover, that was a kind of another dislocation in the post-COVID era, and then going back to the great financial crisis and other dislocations. We tend to be steady investors. I know the private equity industry likes to use the term risk on, risk off. That's not a term we use internally. We are always looking for ways to deploy capital no matter what the environment is. When the markets are great, we try not to deploy too much. And when the markets become uncertain, we try not to stop deploying. And we're, looking for opportunities, using our strategy to find good businesses that maybe have traded off a little bit, but are good long-term investments. So we're trying to be thoughtful about how to navigate the environment. Obviously, there's a lot of risks out there, but what we're not doing is kind of putting our head in the sand from a new investment standpoint, and just waiting around to see how everything plays out. And similarly, on the exit front, we try to build and have had success building really high quality companies. That's what we aim to do with our teams. Just in the last 2 weeks, we announced 3 different sale transactions, kind of in the midst of this environment. So, on both ends, both on deployments and on exits, we're just continuing to forge ahead. But, as you point out, incredibly tricky times.
Yeah, chaos is a big word. This is an extraordinary cycle, in my opinion, our opinion. I've been in the industry since '89, and usually the Fed is helping you with decreasing rates. Here we had inflation, and we had a cycle of high, cheap money, as people were referring to earlier, both debt and equity, and prices going up and up and up. And now we have, for the last few years, we tracked the industry pretty well from $100 billion to $1 billion. 47% of companies that went to market did not get sold because there's a dislocation between the valuation that people haven't marked yet and these fairly attractive unrealized IRRs with what the market will pay. And that's why we're seeing historically the longest elongation of the J curve, very low DPIC, and I think there's a few more years before we really understand what's happened in those late 2000 teens and early 2021 vintages.
Well, you joked. No one's paying 6 times anymore.
Well,
Andrew,
I wish. Yeah.
Andrew, how are you thinking about exits when most of they probably paid 3 times that on average, 18, 19, 20? Are you seeing any movement on the exits?
Yeah, I think in terms of exits, again, our multiples fall more into sort of Scott's worlds where we're entering. And again, we did exit 3, like Dean, not in the last 2 weeks. That's fantastic.
It's amazing.
But in the last year, we've also deployed about close to $3 billion of enterprise value of deals in the last 18 months. But specifically in the exit market, I think creativity is going to be incredibly important. I think giving optionality to hold the asset for longer will lead to a more fruitful negotiation around that. I do think there are willing buyers, but it is not the environment people thought they were going to see when we started 2025. We're happy we operated with a sense of urgency in 2024. We did close our 11th add-on acquisition year to date about a week ago, and we'll continue to deploy capital into that. And to Dean's point, if you build great companies, the strategics do come. We still have relatively healthy balance sheets out there and a healthy system. We're seeing the debt markets are fairly wide open at this point. Maybe spreads are 50 or 100 basis points more than they were, let's say, 3 or 4 months ago. But there's so much private capital that's been raised and the banks are willing to do business that there definitely are deals to do. And I think we're going to see some acceleration in the M&A market.
Let me make a point. We went to market 8 times, got 7 sold, 3.4x gross, marked at 2.8x. And the issue that's going on out there is not just the valuation multiple, it's the pro forma EBITDA, what we labeled as madness. And people are trying to, it's a matter of how much pro forma is really of quality versus not.
Yeah.
And that's working through the system too. So it's not just the purchase multiple, it's the quality of earnings issues that occurred during this boom.
Yeah, I would just pick up on one other point. It's kind of interesting. Obviously, we're in chaos. It's just an amazing contrast. Like you said, when we went into 25, I think everybody was pretty optimistic that we were going to have
Here we go.
a pickup in M&A, pickup in DPI, and an administration that was going to be, pro-business, pro-growth, a friendly FTC. And I think everybody's a bit in shock on how different, 4 months in, 5 months in, the world is. But, obviously we'll see what's next.
But it's sort of a back to basics type private equity model, right? If you're increasing the cash flows of these businesses 50 to 100% under your ownership period, it almost doesn't matter what multiple you sell it at. You're still going to have created value. So you should go ahead and take whatever multiple is being offered to you if it's time for you to sell and it's time for another firm to take that over.
Molly, last word in this chaotic, madness-filled world. How are you positioning the portfolio?
I don't have any more words than were said already. It's not what we expected, but it never is. So you just have to build a raft, if I come back to my analogy.
Well, wise way to end. And on that note, we're going to have to wrap up. Let's join me in thanking my panelists.